Good gains here. Ian, tell us about them.
Yeah, happy with these numbers. Really carrying good momentum from the first half of this year into the third quarter. We've seen quarter-over-quarter revenues up across our three main businesses. Adjusted profit before tax improving by 8% year-over-year. So good loan growth, building that revenue, consistent cost control across the piece, and we continue to maintain a very strong capital position overall for a balance sheet that's very liquid and benefiting from rate increases coming through the Fed. So overall, third quarter, reasonably happy with where we are and very focused on closing out 2017 and delivering the targets we put to investors back in 2015. So reasonably happy with the progress that we've made through the third quarter, Ashad.
Yep, and thing is, Ian, geographically speaking, how's it going that way? Where's the growth coming from?
Well, certainly the lion's share of our profit before tax is coming from our Asian businesses. That, again, is derived to a significant degree by the pivot to Asia that we talked about a couple of years ago. Continued investment in our businesses there, and we've seen the benefits of that investment come through our retail bank, wealth management, commercial banking, and global banking markets businesses, all of which grew revenues year-over-year for the third quarter, and in fact year-over-year on a nine-month to year basis. So overall, the focus of our Asian businesses is continued delivering that strong offering of services and products, improving the overall digital capabilities within our business, the ability of our customers to access us through their mobile apps. And that investment is certainly beginning to reflect in the numbers that we've put in the marketplace this morning. So overall, Asia, hugely important for us, and that's a composition of our Hong Kong market, mainland Chinese businesses, and those businesses further afield from Hong Kong in Singapore, Malaysia, and really across the Asian market. So very happy with progress in that part of the world.
Ian, you did flag up a couple of years ago about, well, a year or two ago, about the private bank side of things. Is the private bank out of the woods in your view?
The private bank has largely completed its repositioning. Peter Boyles, the CEO there, and his team has been hard at work over the course of the last 3 years, really shaping the portfolio to better match that of our other three businesses. We've got a lot of, if you like, synergies between our private bank, our retail bank, wealth management, commercial bank, and global banking and markets. And Peter and the team have largely completed the repositioning. And we really see that in terms of the composition of our assets under management aligned to our key markets. As that assets under management and net new money continue to improve, we will start to see that coming through the revenues and the overall profitability of that business in the coming quarters.
Well, tell me something. What about one of the reasons that we're attributing your numbers at the moment is to deposit income growth here? How do you sustain that? That's going to be a challenge for you looking ahead.
Well, look, we've got an incredibly strong, a very strong deposit base across each of the markets in which we operate. We very much stick to a principle of building our deposit base before we go out and do lending, and that's reflected in our asset-to-deposit ratio that's just over 70% this quarter. A significant part of that is denominated in US dollars, so as the Fed moves its rates higher, we see the benefit clearly coming through liability and liability spreads for our business. So to the extent that the Fed, or for that matter, other central bank authorities move their policy rates up, and where we've got significant deposits in those currencies, for example, sterling, the euro, to complement the dollar, then we will continue to see benefits coming through. The other important factor is year over year, we continue to grow that deposit base. So I think we grew that deposit base year over year by about 2%. And so keep maintaining that balance within our balance sheet is extremely important.
Absolutely. And when we have a look at what's going on as well with the amount of money that you have, and I'll come to where you exit some of the businesses around the world and indeed also in the US. I think you're targeting share buybacks, what, $5.5 billion over this year. You're planning $2 billion in the second half of this year. Where are you with that currently?
Yeah, as of Friday close, we had about 71% of that buyback completed. We'd certainly expect to complete that by the end of this year, and that will then complement the previous buybacks that we did in 2016 and earlier in 2017. So with that $2 billion completing later this year, we'll have a total of about $5.5 billion over the last 18 months.
Yeah, and OK, that actually brings me to the position when, with the dividend. I'm just having a look at the dividend, the yield. Pretty good, 5%. Is that sustainable longer term?
Yeah, absolutely. I mean, of course, the dividend's very much related to the overall profitability of the business. And as you've seen over the last few quarters, the profitability of the group overall has continued to improve. Laterally, that's been informed by our ability to grow revenues across our key markets. Very strong cost control across the business, whilst continuing to invest in the digital, mobile, and product and service capabilities within the business. So we've got a pretty solid equation coming through, and we're improving our return on equity. We haven't quite attained the target that we set in 2015 of a 10% return on equity by the end of 2017. But we're getting there. We're making good progress, and we certainly expect to hit that threshold and then progress from there. So yes, overall, our view is the dividend of an annual dividend of 51 cents per share is certainly sustainable under current operating conditions.
Tell me about the plans for the Middle East looking ahead, and how you grow the business there, and what your strongest and weakest parts there that you need to address.
Middle East North African businesses have continued to perform well for us. They've maintained a very strong performance in 2017, very much in line with which we accomplished in 2016. We're a well-diversified business across that part of the world, with operations in the Emirates, across Egypt, across Saudi. So I think we've got good balance in the portfolio. We've always been very adept at responding to different stresses and strains economically within that environment. So we're very, very happy with what the team has done in the Middle East North African operations for us over the course of the last few years, and maintain a strong focus in supporting our customers and their business in that part of the world.
Absolutely. And Ian, with the news that we've got, of course, that foreign reserves falling quite rapidly in Saudi Arabia, looking at a consumption tax there, a tax also on expatriates. How much are you making provisions for that? Because you're bound to be under some pressure when all those things kick in.
The majority of our business in Saudi is conducted through an affiliate called Saudi British Bank, of which we own 40%. And the performance in Saudi British Bank has been very, very stable over the last several quarters, last several years for that matter. Clearly, the economic reforms that the government is implementing in Saudi, we all think are headed very much in the right direction, but recognise that it'll take some time to implement those reforms. And this is not different for us in terms of the diversity of the geographies in which we operate to adapt to different operating conditions. So far, that business continues to operate very, very stably, strong customer base, good profitability coming through it. But very much one of those around the world that we keep a close eye on.
Return on equity still, or ROE still, well below 10%, just shy of the 8% mark. Now, how do you revive that? It is one of your goals to get it above that. I mean, you've been very successful with other things like the capital tier ratios, etc. But how do you get your ROE above 10%?
Well, look, I think if you look at where we are this year versus last year, we're at an ROE of 4.4% for the 9 months ending September 2016, and we're 8.2% ROE for the 9 months ending September 2017. That's pretty good progress, I think. We're certainly on that trajectory to hit that initial threshold of 10% return on equity that we set out. I don't think we'll make it by the end of this year, sadly, but we're taking the actions around continuing to invest in growing the revenues of our business very much within our risk appetite, continuing to deliver significant cost savings. By the end of this year, we will have delivered $6 billion of annualized cost savings through a range of different initiatives around improving technology, digitization, mobile access for our customers, as well as simply process streamlining and simplification across the business. And then the third leg of that is very much focused on the efficient deployment of our capital. And again, by delivering on very significant reductions in risk-weighted assets. Since we launched that initiative in 2015, we've taken more than $300 billion of risk-weighted assets out of the business and either redeployed those more profitably with our customers around the world, or as you've seen, returned some of that to our shareholders. So good progress, but we're not quite there yet.
Yeah, Ian, let's just talk a little bit about Stuart Gulliver, outgoing CEO, of course. He said he remains committed to have, I think you call it jaws, don't you? It's the revenues versus costs here. Do you want to be positive when it is for this concept of jaws for the full year? You're not there for the quarter, but Are you going to do it? Because you do have to spend money out there in order to fuel expansion.
We will. We were positive jaws through the half year. We've made significant investments through the third quarter, like most other quarters for that matter, and have resulted in somewhat negative jaws in the third quarter. But we absolutely anticipate having a positive jaws for the full year. And that's really what we focus on, is a year-by-year basis, being able to deliver revenue growth slightly ahead of our cost growth. That's really what jaws means, is a revenue rate of growth being ahead of the cost rate of growth, and therefore delivering some operating leverage. Good progress in that regard. Again, you see it coming through growing revenues, you see it through good cost control. So we would anticipate delivering positive jaws for the full year 2017.